Today we have an amazing group of people for the aptly named crypto panel. We have Greg Tusar, who is the CEO of Tagomi, a trading firm. We have Jeanine, Hightower-Sellitto. We have Trey Kelly, she's at Gemini, which is a cryptocurrency exchange. We have Trey Kelly, who runs GRIID, a mining firm. And last but not least, Ari Paul, who runs BlockTower Capital, a hedge fund, and full disclosure, an investor in my company, The Block, which is a media and research firm. And we have a great institutional product for asset managers called Genesis. If you want to talk to me after the panel about it, I'd be happy to tell you all about it. There's my shill for the panel, and we shall move on. I think the best place to start, just given the backdrop of everything, right? Where the anxiety over whether there's a looming recession, those anxieties are easing. But there's still these there's other questions in the background. Underfunded pensions, the growth of government debt, budget deficits, the race to print more money. And many pundits, many folks in the Bitcoin world like to think that all of that is good for Bitcoin as a hedge, as an uncorrelated asset. Is that true, you think, Ari?
Totally, and I've definitely been one of the pundits in that role, kind of promoting that view. So I'm a big fan of Ray's, and I've somewhat frequently posted things like Ray Dalio's essays, and then saying he concludes by gold. He's not saying by Bitcoin, but the exact same logic, in my view, applies to owning Bitcoin. So I don't want to ramble on the point, but just to say very succinctly, a lot of the traditional global macro hedge funds we talk to, the employees and the owners, most of them own Bitcoin themselves. And for their funds, they're considering it. And they're kind of looking for confirming evidence to view Bitcoin very much the same way they think of as gold in their portfolio, potentially as a hedge to things like global currency depreciation, debt crises, just general instability.
That's a good point. How many folks in the audience own Bitcoin? How many folks in the audience think cryptocurrency is just a cesspool? All right, so about even. About even, right? Why isn't it a cesspool, Greg?
So I think that one complicating thing here is even understanding what cryptocurrencies are in the first instance. And so there are many, many sort of micro narratives within crypto. So there's clearly, and the winning and most prominent one right now is Bitcoin as cash commodity, as digital gold. But when you take a step back and look at globally, what are the different ways the underlying technology is being used? It's a commodity. It's potentially a way to issue equity. It's a way to digitize and tokenize other assets. It's a potential payments mechanism. And when you look at the universe of potentially tradable cryptocurrencies, each one of those fits a different use case. For sure, in the here and now, Bitcoin is the preeminent crypto and the one that's most likely usable as a macro hedge and as digital gold. But I think there are a lot of micro narratives that you really have to consider, including things as big as looking at big tech and why does value inure to the operator of a network like Uber or Facebook or rather than to the underlying producers and consumers of goods and services. And so crypto as an asset class is potentially very big. In the here and now, I would focus on Bitcoin as the most usable and most practical crypto asset.
If we buy into this idea of Bitcoin being a store of gold, and my colleague Ryan today made a point similar to yours, Ari, which is, in a sense, Dalio yesterday might have been making a case for Bitcoin without really knowing that he was. But if we even buy into that, and we buy into the thesis that it can serve as this form of digital gold, I'm sure from an asset allocator's perspective, there are so many questions around how do you price this thing? How can I value it? There's no real measures to do that, perhaps. There's the question of hacks. How do I store this? So even if you get over that first hump of seeing that there's a thesis there, how do you get over that second hump, Trey?
Yes, I think one of the things that we've seen, and we saw probably 3 times more hands for crypto's a cesspool than I own Bitcoin. And a lot of that is for good reason, and I can empathize with that because, first of all, it is a very dense subject matter. It's the intersection of game theory, cryptography, math, computer science, and on top of that, you have, so the learning curve's relatively steep. And on top of that, you saw in 2017 and early 2018, anytime large amounts of wealth are created in a short amount of time, you attract all the scammers and fraudsters. And especially when it's done in a form of money. So what we've seen is a huge spike in the ICOs. Many of those, the headlines are much easier to grab with negative news than with positive news. So we're not seeing as much around how this can be an uncensorable store of value to go across borders. And you're seeing much more, retail investors scammed out of millions of dollars. And so, the two of those things coupled together, one, you've got to dedicate hundreds of hours of time to be able to understand this and have working knowledge of the space. And secondarily, what we saw in 2017 and 2018 with the ICO bubble, attracting a lot of those folks who did not have the right intentions.
What do you think, Ari? I feel like there are, I don't know if it just can be explained away by saying, you haven't done enough homework or you haven't necessarily researched this complex topic enough. There are a lot of characteristics about the space and Bitcoin that make it uninvestable for many people. What do you think are the top reasons why it is, though?
Kind of two different angles on this. So the clear list of obstacles as I see them right now, regulatory uncertainty, which occurs around the edges. So Bitcoin in most developed countries is very clearly legal. There's a clear tax. The regulatory regimes are actually quite clear around Bitcoin. But around other assets, it's less clear. If you're trying to be a service provider, like a custodian, like an exchange, it's very challenging because, for example, there's a massive backlog of broker-dealer registrations with various regulatory agencies. So if you're trying to become a service provider, it's unclear what regulators want from you. It's unclear what, how you can be regulatory compliant. It differs by country, and there is existential concern that that could change. So while Bitcoin's totally legal in the U.S. today, none of us know what Donald Trump might tweet next, and what kind of, even if it remains legal, what kind of pressure might there be on financial institutions? For example, a lot of big banks will close your account if, for example, you do a legal transfer of US dollars to Coinbase. Everything about it is legal, but banks are kind of scared. The Treasury Department may pressure them, may look at them more closely if they're supporting those kind of transactions. Another is the operational infrastructure. Things like audits are difficult, fund administration, everything is somewhat unwieldy and ad hoc. All of this really boils down, in my mind, to this amorphous concept that really runs all of finance, which is abstract trust, which is really psychological. So I'll speak for myself. I don't really know how cell phones work, but I kind of just trust that they work. And I might, as an investor, invest in a cell phone company without having a really deep engineering understanding, because I kind of take that for granted. We build up these massive stacks of technology. If we're evaluating Facebook today, we don't really think of it as a tech company, right? We're not worried their databases are going to fail. We think of it as a consumer product company. We kind of take the tech stuff for granted. And I'm gradually seeing that happen in cryptocurrency, where when I used to give talks on it in early 2017, I would be explaining very bare bones, detailed, granular items about how a blockchain works. Today, to that same audience of a CFA society or group like yourselves, it's not that you guys are experts in what a blockchain is in a technical sense, but you probably have enough of an understanding. You've heard that same explanation given enough. You've heard talented technical experts verify it for you. So there's some truths about it you probably just take for granted and trust at this point. So building up this stack of trust is a huge part of how finance and life works more generally. And that applies with institutions as well. So for example, Fidelity getting into the custody game and the launch of CME futures on Bitcoin in 2017 were both very exciting events because it lends that kind of, it enables us to blindly trust. If the CME has Bitcoin futures, we kind of trust that they're doing their job. That lends a lot of credibility. Institutions like Fidelity custodying, we don't need to do as deep diligence into the custody processes. We don't need to feel like we're experts on hardware security and cryptography. We kind of trust that Fidelity is going to do that, especially if they have a top name auditor come in and verify their work. So I think we're very slowly building up this stack of trust across a huge number of different areas, almost all of which are still incomplete. But the reason people in this room will be comfortable custodying Bitcoin at Fidelity in 3 years or 5 years is not because you're going to be suddenly experts on cryptography. It's going to be because you trust this web of expertise and institutional knowledge that is built up over time.
And I'm sure Jeanine would want them custodying with Gemini Trust, but what, from your perspective, to bring you into the conversation, over the past year and 3 months that you've been with Gemini, a cryptocurrency exchange, they're also custodying assets for different investors and such and trading firms. How has the client profile changed, and what has changed their minds about the space and helped them cross that chasm to invest?
So Gemini provides spot exchange as well as storage services for cryptocurrencies for customers that want to buy and sell cryptocurrency on our exchange, as well as store it in a cold storage facility similar to what Ari was talking about with Fidelity. Gemini, unlike some of the other competitors in the space, operates as a New York State trust company, regulated by the Department of Financial Services like any other trust in the state of New York. It's one of the big hallmarks for our market, and one of the things I think is really complicated in the crypto landscape is the web of regulatory frameworks that exist in the US as well as other jurisdictions for trading and participating in the crypto markets. There is no federal regulator like the SEC. I worked in the options business for a really long time. Our markets were regulated by the SEC. We only dealt with sell-side brokers. They were all regulated by FINRA. And so when customers and investors were doing business with the exchange, no one really had to think about, was the exchange, facilitating money laundering or abetting terrorists or things like that. And so there's different standards for the cryptocurrency markets in terms of who you're doing business with, what regulatory framework do they operate under, and are you comfortable as a business participating with those companies? So for Gemini, as well as some of the other more reputable participants in the space, reaching out to institutional investors, which tend to be, at this point, crypto hedge funds, some family offices, and we're starting to see more interest from some of the larger investors in this space, but they're not really here yet. I don't think anyone on the stage would tell you that there's, anyone probably in this room perhaps that has part of their fund devoted to crypto, but we are seeing some endowments make progress into the crypto space, not necessarily on the listed markets. A lot of those transactions, like other asset classes, are done on an OTC basis. But certainly from the custody side, there's a lot of interest in how you actually go about storing these assets. Some of the biggest challenges people have, and I would beg to differ with Ari for some polite disagreement, that simply trusting someone's brand name is not enough, especially from some of the firms that have subsidiaries operating their crypto businesses where there is limits to the liability for those businesses. It's not really Fidelity you're working with, it's a subsidiary. So I think the biggest thing that we've seen is a lot of the institutions that are looking at crypto are really starting to hire and devote resources to looking at this space, and that's really the first step to people investing in the space. I wouldn't recommend anyone just blindly buy Bitcoin and go to Fidelity because they know them as a brand name and they think it's a good time to buy. It's not only hiring the right people that can really understand the product, but can understand the technology and the security profile. It really is a small and emerging market at this point because there really isn't that much experts in the space. I think it's really hard to hire people that have longstanding expertise in the space. The industry's only been around for less than 10 years, and so, or 11 years, I guess. We just had our 11th birthday. So I think that's where people are at, and I think we're seeing continued growth, even through some of the slower periods of price movement. Granted, of course, when prices are moving, everybody's interested. It's making headlines in some of the main papers, and people are interested in looking at it as an asset class because they're looking at sizable returns. But I think it's the longer-term trends of people developing their digital asset task force, the expertise in-house from a security side, first and foremost, and then from an investment side.
Mm-hmm.
I think part of the reason to invest some amount of time into this, there are a lot of different ways that crypto will end up manifesting over the next decade. Like we talked about before, one is it's a way to raise equity, right? So it may come to pass that some of the companies that you invest in are going to want to give you tokens rather than shares or something else in the future. And
why do you think that is?
I think the ethos around crypto generally, like I started my finance career on the floor of the exchange. I ended up working at Goldman for the bulk of it, helping institutional investors trade more effectively and shaving basis points off of executions and that sort of thing. And over that period of time, there was a general trend towards disintermediation and reducing frictions and getting getting frictional costs from hundreds or thousands of basis points down to now fractions of basis points. And the general idea behind crypto in all of its manifestations is reducing intermediation. The distance between producer and consumer of goods or services, generally, it's not the case in every instance, means that more value inures to those two counterparties, and less is lost in the process to people who are intermediating along the way. And that means everything from it's a token that you get in the form of equity, and how you custody that and do all of those things. There aren't 5 people in between, or in the case of payments, you're losing less in the form of money going to payment processors and all of the related intermediaries, et cetera. So the reason to spend some time on this now is one of these different manifestations of crypto will take hold. Of that I'm very convinced, but it's impossible to know which of them is really going to be the preeminent narrative in 5 or 10 years. And investing some time to understand, how do I store it? What are the operational belt and suspenders around? I would need within my fund to have people who can trade it and do operations for it, or how do I evaluate counterparties and credit risk, and all of those things are going to matter as the asset class evolves. But there is very clearly in the here and now a Bitcoin as store of value narrative, which I think is very worthy of time and investigation. But that by itself wouldn't be the reason to spin up a team, a group, having some time invested in the digital asset space writ large.
To what degree are those two things connected in terms of the transformational impact that blockchain and tokenization can have on, let's say U.S. equity trading? That's one thing. Does that benefit? Does that have anything to do with Bitcoin's value or the value of the cryptocurrencies?
I mean, the common denominator to those is understanding operationally how to deal with them. What do I do once I bought it? Where do I go to buy it? How do I not pay 5 to 10% in transaction costs or whatever it is? It's much less now, but those are the things that are in common between buying Bitcoin and buying, a token that's related to a smart contract that someday will have a much larger use case.
And I think part of that too is that those are big words and new words and intimidating words. Like tokenizing equity just means that instead of tracing back to a piece of paper, we live in a digital world, it's digitizing that equity. And why would you do that? So that there's less friction in the process. And why would you use blockchain? Because it's a distributed, replicated database where there's not one centralized server keeping those records.
Sure.
And so it's more redundant, it's more convenient. It's just digitizing what we're doing today.
I'm going to play devil's advocate on the other side of the coin, no pun intended. Many people might argue that we have, in the United States, the most liquid capital markets in the world, and that if I want to make a large trade, go in and buy, 100,000 IBM or something, I could very easily do it.
Correct.
Why reinvent
So
the wheel? Or
this can
if it
be
ain't
private.
broke, why fix it?
Yeah, I think, when we're talking about the equity piece of this, a lot of this is, access to private markets as well, and keeping tabs and tally of those shares. Anybody who's delved into cap table math knows why Carta exists and some of these things. They can get quite complex, and so having a trustless system. The only thing Bitcoin and this idea of tokenizing equity with smart contracts, which is just a simple way or a complex way of saying simplifying the process to make these things digital, is that they're built on blockchain technology, which is just an inefficient database because it's replicated all over the place instead of one centralized server. To me, that's kind of as far as it goes.
Well, and I think the other thing that comes along with that is just the access to a wider distributed base for potential investors in any of those projects because of the lower cost and the profile and the effort to distribute them and keep track of the record keeping, which is ultimately what differentiates it from a traditional placement offering.
I'll add a few points. So I think I don't know if this sounds outlandish or too, in the crypto world, this would be a very conservative prediction, but I think in 20 years, regulators
Bitcoin 100,000.
No, I think within 20 years, regulators will require all equities in developed countries to be tokenized. And the reason is very simple, that right now there's no real-time transparency into who owns what assets. It's very hard to do criminal investigations. For example, let's say there's a big options trade in Microsoft stock right before an earnings announcement, and the SEC says, we want to investigate that. That looks like insider trading. A good chunk of those investigations get abandoned due to difficulty because the custody of the options trade goes through so many intermediaries that it takes a huge amount of SEC manpower to investigate who actually did the trade, which is comical. I mean, we're using basically 40-year-old technology and not availing of ourselves of very, very simple, mundane, real-time transparency. Another thing with the idea we're using the term smart contract, which is basically just code, is regulators can build regulation into the asset. And this is not sci-fi, this is very, very simple, it can be done today. So if regulators say, for example, a investor should not be able to resell a security for 1 year. Well, currently, they have no way of stopping the resale, they just punish people after the fact. What if you could build that limitation into the asset itself? The asset literally is not transferable for 1 year. That just makes everyone's life easier. It cuts down on, it makes enforcement much easier. So central banks love it, regulatory agencies love it. It means eliminating a good chunk of the back office of basically every financial institution because this stuff just becomes a mundane routine database instead of trying to figure out, like I was a treasury bond trader in a former life, and for example, cascading failures to deliver is somewhat frequent, where Credit Suisse sells a treasury bond to Goldman Sachs, who sells it to JP Morgan, who rehypothecates it, and one entity has a back office failure, and you end up with this crazy mess that takes a week to unravel because no one knows who actually owns what bonds. All of that is very silly because this is already digitized, right? We're just using basically 50-year-old databases. So this won't happen overnight. I'm not naive. The change happens extremely slowly when you have kind of these entrenched bureaucracies and technological systems, but this is the future in a very, very simple, mundane kind of way.
I think if I was sitting in the audience, I would appreciate that sentiment and get, all right, sure, maybe blockchain tokenization improves trading, might help with the regulatory agencies in finding nefarious actors. But I still don't understand why that's good for Bitcoin. Mm-hmm. And maybe it's not. Maybe they're two completely different things. But are they connected?
I think of them as mostly separate. The underlying technology, which enables real-time transparency for settlement of financial value, is kind of the theme that connects them. But mostly they're separate. I mean, so this kind of leads into a topic I imagine is on a lot of your minds, which is things like Libra and the Chinese national cryptocurrency, DCEP, FedNow, all of these other things. A question that we deal with as cryptocurrency investors is that bullish or bearish? Are these competitors to Bitcoin? And I do think you get an effect of socializing, normalizing the idea, the technology, and the user interfaces. So similarly, if we're tokenizing equity and creating infrastructure to securely transfer value via these ledgers, you do get benefits for Bitcoin, a terminological distinction that's also ideological. Like, how do we think about the difference between, if the US dollar is turned into a cryptocurrency, as the Federal Reserve is talking about half doing with FedNow, how should you think about that versus Bitcoin? A really simple dichotomy is permissioned and permissionless. So Bitcoin, anyone can do a transaction, and there's no, basically censorship is close to impossible. Whereas obviously with the Fed dollar, it's a controlled system. So the term permission to permissionless is the best I've heard to capture that. And I think the spread of permission systems like tokenized equity do benefit the permissionless just by, similar to how almost any investment in internet infrastructure benefits every internet company. You get more users, you get more general investment in tech that ends up getting, for example, a crypto US dollar ATM can probably also be a Bitcoin ATM very easily with a few lines of code.
Sure, fair enough. How many folks in the audience buy into this idea of tokenization or blockchain? How many of you are blockchain but not Bitcoin types? So you get blockchain, you think it's going to be great, but not Bitcoin. How many of you think we're big nerds? None. Good. All right, perfect. So let's focus then on that. I'm sure many of you have conversations, whether it's with potential counterparties on your trading platform or with potential folks looking to trade on the exchange and maybe just your old hedge fund friends, right? What do you think are some of the main reasons why how would you push someone who gets blockchain, understands the benefits and the efficiencies it adds to the system, but don't think that there's a value in the Bitcoin trade, especially with this backdrop, right? You look at things that are going on with Hong Kong, the unrest that's there, and it's translating into the volumes on those exchanges, on the Bitcoin exchanges, exploding. Because what you have is a it is a censorship-resistant form of money that I can transfer very easily across borders, right? Or in Argentina, where you have crazy inflation, many different areas of the world where you have insane inflation. Well, it's a store of value. It's going to protect my wealth. Are those the two key things, or are there other aspects?
So those are a couple of the key things, and I think it highlights something about Bitcoin and crypto generally that are unique about this asset class, which are that it's global and borderless and virtually censorless. So that actually, from a regulatory perspective, makes it hard. So we in the U.S., regulators would like to have the ability to go to an exchange and put forth some rules and regulations. But at the same time, Bitcoin operates 24 hours a day, 7 days a week, in a very globally connected set of networks and exchanges, some of which would be in the U.S.'s jurisdiction and some of which would not. And that's made it difficult for regulators to get their arms around, how do I make sure there are sensible, rules around exchange participation, good AML and KYC, et cetera. There is a global move to adopting better and more stringent KYC and AML rules and regulations and a set of guidelines that the FATF put forth, and I think a serious desire to shed this idea of crypto as a venue for money laundering. But it's a challenge, and it's unique to crypto because it is so global and well connected. But that also is a feature, right? So in countries where there's rampant inflation and you don't want to own local currency, it is easy and possible to use crypto as a way to to hedge yourself against the effects of whatever local policy and currency policy are.
Mm-hmm, mm-hmm. What is the largest, or how? You might not be able to answer this, but what is the largest hedge fund that's linked up to your system, or
Yeah, I can't
give
answer that.
maybe a range?
Sorry. So
Are there any big, macro
sure.
funds?
Yeah. So I think this was mentioned earlier, but the likes, some of the largest endowments. So this was publicly announced that Yale and others had allocate of order hundreds of millions of dollars to a crypto dedicated sleep. So what we see as typical investors. So we started Tagomi as a place where an institutional investor could open an account, sort of a brokerage firm for crypto. So rather than going exchange by exchange and establishing relationships and worrying about what do I do with my stuff now that I've got it, the idea of a prime broker in crypto, the same that you might have in other asset classes, was our idea. And so what we see is everything from I'm a VC and I've created a sleeve for my LPs to get crypto exposure, and I now need to buy of order tens or hundreds of millions of dollars worth of Bitcoin, Ethereum, generally the large liquid tokens, to crypto-specific hedge funds like ours that are experts in this asset class and understand all of the things that we're talking about. And that tends to be where, to the degree there are organized asset managers in the space, they look more like that from our point of view. We've seen very few traditional investment managers step in, as Jeanine said earlier. And then after that, miners. And so these tend to look like the institutions and entities in the crypto space today.
Mm-hmm, mm-hmm. But there are problems. I mean, we don't definitely want to paint this as a panacea or as a perfect solution to everything, or a perfect market, right? If you look at things like we talked about this in the prep call, the growing, what some are calling a credit crisis in the cryptocurrency ecosystem, $5 billion worth of originations for a market that's $200 billion in market cap. You have firms coming online, it almost seems like every month, with a new lending offering. Interest rates are at like 11%. Sometimes you can find them much higher if you go to some of these staking coins. 200%, right? It's pretty remarkable. Bloomberg noted it as a possible, or someone in a Bloomberg article noted it as his biggest fear this credit bubble as potentially being the MF Global or Lehman Brothers moment happening. Is it something that worries you as an investor?
It's not yet that big. I definitely think it could grow to that scale. I'm definitely concerned that similar to in any financial market, that people are attracted by high yields without really understanding the risk they're taking. So, for example, to be frank, the cryptocurrency industry is is a young one and is populated with a lot of brilliant young people, as well as some industry veterans, who come from traditional finance. But there's a lot of people who are very naive about very simple things like counterparty risk, which of course can happen in traditional finance as well, when we were all sure the prime brokers couldn't fail and the buck couldn't break, and we were all totally certain that it was impossible. So it happens in traditional finance as well, but in cryptocurrency, it happens very easily that people are just naive about the risk they're taking, particularly on counterparty risk and technological risk and things like that. But at the moment, the scale is pretty small of the lending operations. An existential fear, this happens periodically, is you get a large exchange failure. Because in cryptocurrency, it's the most attractive asset in the world to steal. Because if you steal, if someone's going to steal $100 million via bank wire, it's pretty hard to get away with. If someone steals $100 million in cryptocurrency and they know what they're doing, their odds of getting away with it are fairly high. So exchange operators, exchange employees, and hackers target cryptocurrency exchanges for good reason. There was I forget the name of the bank robber in the Old West, but someone asked him why he robbed banks. He said, because that's where the money is. So today, cryptocurrency exchanges are kind of the obvious place to target if you're trying to steal a lot of money and get away with it. And they fail periodically, big ones, large failures. It spooks the market every time. And over time, we are building up a little bit more robust security practices, a little bit better general understanding. So I don't think it's a pressing concern for me, at least, but the risk of a major credit bubble is certainly high as people flood into these high-yielding products.
What do you think, Trey?
Yeah, I mean, I think I share similar sentiment. I think largely, that's not a crypto market specific fear. I think one of the things as I think about all the folks in the audience and their perception of Bitcoin, taking it for what it is in the stage that it is, and given the fact that we've seen such volatility, what comes to mind for me is like there are ways to get involved in Bitcoin without being a long-term bull or believer, and more so than just trading the volatility too. I think one of the things, so we mine Bitcoin, so we look to secure low-cost defensible power around the world and believe that independent of Bitcoin, value will accrue to low-cost power, whether that's because of the high-density data center or because you're mining Bitcoin or both. And so I think there's a certain perception that I have to be fully bought in to get involved, and it's intimidating given the volatility of the market that if you start to build a position, might it fall off a cliff or might it go through the roof? We saw a 42% move just last week, and it happened to be on the upside, but we've seen just as many on the downside. So I think there's merit to the trepidation in the market. I'm sure the traders love that because it's a trader's dream with the volatility and the 24/7 markets. But I think it's important that we come in eyes wide open, knowing the market that we're in and being aware of the positives and the negatives and kind of the growing pains independent of our own personal beliefs in Bitcoin.
And I think this market is really developing. The market that exists today for crypto is not the market that's going to exist in 12 months or 5 years or 10 years. The structural differences between a traditional equities or futures or derivatives market is very different than a spot market in the US even, and certainly internationally for crypto.
No 100x leverage on
No
Gemini.
leverage at all. It's one of the interesting things for me joining this industry is that there is no leverage on Gemini. It's full reserve, as are most of the other legitimate crypto exchanges. And so you need to go to an outside vendor who can provide that leverage to you. Those are just in their infancy. There's only really a handful of people doing it legitimately in the space today. Your choices are limited, and there's pretty big opportunity for those businesses to grow there. At Gemini, as I mentioned, we're an exchange and a custodian, and we don't necessarily think we need to provide every service in the industry to every investor. It's an ecosystem that's evolving, and there's different players coming in to fill some of those roles. But there are some things that are sort of missing in the space today. Apart from the full reserve on each exchange, there's no central clearing feature. You really is a patchwork of exchanges people are doing business with that have their own set of rules and regulations and what products they'll list and their own KYC standards. And so navigating that is kind of difficult. I think that will mature over time. Gemini, along with some other players, are trying to develop a regulatory framework, at least in the US, for exchanges, for spot market, so that there's comfort for people looking to invest in the space. On the retail side, as well as the institutional side, I think one of the things we haven't set up here to date is this market is still very retail focused. Probably, at least half of our business is focused from retail customers. And that's also different than the options business in the US, which has probably got similar statistics. But it is a very retail-driven market, and so making sure that we're doing the right things to protect those customers from a security perspective, from a market surveillance perspective, from a compliance perspective is really important to gaining legitimacy, not just with the people in this room, but the people in Washington and where we want to be as an industry, 10 years from now. And that's what I think the players up here are speaking about, where we want to focus on growing so that it's a different conversation next year or the year after when hopefully we're back talking to you.
Well, hopefully we can squeeze in room for a question or two. Remember, there's a difference between asking a question and pontificating ad nauseum. Go ahead.
I'd like to challenge the narratives because we all
Please.
sort of Bitcoin went through different narratives. It started with be your own bank, and then it was unit of account and whatever. Now we're talking about the store of value and potentially gold-like attributes. And we trade this professionally as an RIA, and the token trades like a risk token right now. What I'm trying to, driving at is when we're talking to people who come from traditional asset classes, we're always talking about the claims of the technology going forward and what things could become, tokenizing equity issuances and transparency and the virtues of technology. But I think we need to, in order to get the buy-in, we need to talk more about what it is today. And today it trades like a risk token for a particular kind of risk. Mm-hmm. It trades more VIX-like, but not for macro volatility. It doesn't trade like an AUD JPY pair, but it addresses specific kinds of risk, like the Chinese retail going into yuan, going out of yuan, trying to preserve the value because of tariffs and the local currency getting depreciated, or capital controls type issues, or runaway inflation in some countries. That's what it trades like. You can make a credible case and load some factors into the model why these correlates are there. So for somebody from traditional sort of world, now that's what is here and now kind of thing. So I'd like to either get challenged on that and see if you guys sort of agree with us, because we trade this every day for a living. The derivatives, specifically options on the futures, basis trades and all that kind of stuff. That's what it trades like to us.
Mm-hmm. So one challenge, it's worth to start acknowledging that the equity value of a stock trading in the S&P 500 of a company will trade generally very highly correlated to the market. And I think we'd all agree that in another financial crisis, probably everything's down together with correlations near one. That's not because all those companies had fundamental business prospects. That's not because a rise in interest rates really impacts this particular business. It's because you have financial assets, you have underlying business models, and there's a lot of things that separate the performance of the two, right? So you have rebalancing effects, like why in the financial crisis did different asset classes become so correlated. Some of that's explainable fundamentally, but a lot of it is a portfolio effect, right? Investors liquidated their best performing assets to fund their worst, partly just because that's what we do. So Bitcoin's performance, I think of it currently as a risk-on asset. It's correlated positively with equities, I believe. I think we have a generic recession. It probably sells off now. A lot of the value we're talking about, because it potentially serves a different role in a portfolio or as a speculative asset than it does for example, someone fleeing an authoritarian regime, or the idea that it may gain value in that from that perspective. So you have two very different, so like I'll proselytize about one of the reasons that I'm in the industry is because I do actually believe in it as a tool against authoritarianism. Obviously, that's not why you're going to have it in your portfolio. The reason I own it personally and am investing in it on behalf of other people is because I think it will produce a financial return. So those two things, right? So we have use cases which are somewhat divorced from short-term financial impact. So with all that said, here's my answer. It's short-term. I think it does function as a risk-on asset with mostly idiosyncratic exposure. Any kind of statistical model says it's mostly idiosyncratic. It's had 10x returns and 80% falls. Correlation's a very misleading statistic in that it kind of, you can have one asset that ends up after all these cycles up 10%, another up 1,000% that'll show it's 80% correlated, because the days where they both rally tend to be very consistent, and yet the magnitudes are very different in directions. So correlations are high. It's positively correlated with equities, unclear to currencies. It has benefited when the yuan has sold off. I do think there's evidence that people in China have used it as a currency hedge, although it's not that popular for that because they have other avenues that are easier. They have a lot of, Chinese wealthy people have a lot of pipelines to evade capital controls, to hedge the yuan. In Argentina, for example, they mostly don't use Bitcoin, they use dollars, and dollars are easily accessible in a gray market. Over time, the idea that Bitcoin could gain a foothold as an alternative to gold and dollars in an attempt to deal with local currency crises, general global currency depreciation and instability, I think that's a long-term story that I think is very likely, but that'll take many years to play out. And in terms of the fundamental value proposition, I'm not actually going to do this. I thought I'm doing this as a joke, but I was going to say raise your hands if you have an offshore bank account, which I won't do. But there's roughly 30 trillion in the offshore banking industry. Some of that is illegal activity, tax evasion, but a lot of it, every Fortune 500 company, every billionaire who's ever presented here has assets in offshore banks. And every big politician, but every legal U.S. company. And J.P. Morgan and Citibank, they collect a lot of fees.
It's a Swiss bank in your pocket.
Right, and banks collect a lot of fees to provide that service. Why do people want that? Because if you have enough money, at some point, you don't want a single judge in your jurisdiction to be able to freeze your assets pre-trial. You want to at least have a fallback, right? If you're a legal billionaire in the U.S., you want to be able to say, a New York judge can't just freeze my assets pre-trial. I should at least have some money overseas so I can pay for a trial. Maybe if I'm eventually found guilty, I'll be held accountable, but I want some diversification. From a regulatory perspective, from a legal perspective, and that's for US billionaires, let alone Russian, Chinese, Indian, where you just had demonetization a few years ago. So the fundamental demand, it's almost bizarre to me for people to not see the demand for an asset that preserves your wealth from the seizure of governments. Even if you don't personally feel that need in the US, where we're very fortunate, we see tens of trillions of dollars of demand today in very high friction form, right? The friction to open a bank account in Panama or wherever is very high. Imagine if everyone around the world could open an offshore bank account with $5,000 in a smartphone app.
Sure. Well, we shall see. I think we're out of time, but I appreciate the panel. I appreciate the comments and the questions.
The 2019 Greenwich Economic Forum is brought to you by Bridgewater Associates. Meaningful work, meaningful relationships. Churchill Asset Management, Nuveen, a leading provider of senior and unitranche debt to middle market companies. Ropes & Gray, bright past, brilliant future. Aurora Capital, inspiring partnerships. And Gramercy Funds Management, we are emerging markets. Special considerations to Bank of America, life's better when we're connected. Noah Private Wealth Management, a leading wealth and asset management service provider in China. Guotai Jinan Futures, a leading brokerage firm for commodity futures and financial futures in China. China Industrial Securities, a comprehensive financial group providing full spectrum financial services in Hong Kong. And Titan Advisors, built like a hedge fund. Special thanks to the Financial Times and Greenwich Business Institute for hosting us. And thank you to all the sponsors who helped make this event possible. We'll be right back after these messages. Don't go away.